Welcome back to FinScribble. For over a century, investors have lived by one absolute law of nature. At precisely 4 p.m., the closing bell rings, Wall Street turns off the lights, and your money goes safely to bed. Think of traditional stocks like a heavy bank vault. When 4 o'clock hits, the heavy steel doors lock shut, protecting your portfolio from sudden, chaotic moves while you sleep. Jordan relies on this every single night, heading to bed with peace of mind because his stock positions are frozen solid until 9:30 a.m. tomorrow. Meanwhile, Maya watches crypto markets trade nonstop, around the clock. But what if that protective steel bank vault is about to be demolished forever? Lean in, intrigued. Regulators are quietly paving the way to replace the 4 p.m. closing bell with a 24/7 neon convenience store that never locks its doors. And most investors have absolutely no idea what is coming. To understand this massive shift, we need to look under the financial hood. Right now, buying a real share of stock requires a complex web of clearinghouses, brokers, and multi-day settlement delays. But tokenization changes the game entirely by wrapping real-world equities into digital smart contracts on a blockchain. Imagine Maya scrolling on her phone at 2:15 a.m., purchasing a tiny fraction of NVIDIA for just 50 cents, and having that ownership settled directly into her private wallet in 3 seconds flat. In this new 24/7 convenience store model, you do not wait 2 business days for clearing. There are no opening hours, no weekend pauses, and no waiting for Wall Street middlemen to wake up. Tokenized shares trade continuously, allowing microtransactions at any hour. While this sounds like ultimate freedom, removing the lock on the front door opens up unprecedented vulnerabilities for everyday retail investors who are fast asleep. Here is where the true danger lies for regular investors. In traditional markets, overnight earnings or geopolitical news creates a gap risk, meaning stocks jump or drop when the market reopens at 9:30 a.m. But you cannot get liquidated while you sleep because the venue is closed. In a 24/7 market, that buffer disappears completely. Picture Jordan going to sleep at 11 p.m. with his life savings invested in index funds. At 3:15 a.m., overseas bad news breaks, trigger-happy algorithmic bots start selling, and the stock price plummets 20% in minutes. Jordan is fast asleep, completely helpless. By the time his alarm goes off at 7 a.m., his portfolio has already been completely gutted, wiped out in a low-liquidity midnight cascade before he even brewed his morning coffee. The market never paused to let him react. The convenience store stayed open, and his investments burned down in the dark. You might wonder why Congress hasn't debated a financial shift this monumental on national television. The answer is simple. They didn't have to. While key crypto legislation like the Clarity Act remains completely stalled in congressional committees, regulators decided to take matters into their own hands. The SEC is quietly drafting what is known as an innovation exemption. This special regulatory bypass allows financial institutions to launch tokenized stock trading platforms on blockchains without needing new laws passed by Congress. Maya looks at official SEC document drafts stamped with approval, realizing the rulebook is being rewritten behind closed doors. Wall Street behemoths and market makers are aggressively pushing for this exemption because 24/7 trading generates continuous transaction fees every second of the day. Regulators aren't waiting for public debate or congressional votes. They are quietly constructing the rails for a non-stop trading environment right underneath our noses. When markets stay open 24 hours a day, who actually wins? It is certainly not the average retail investor sleeping soundly at night. During off-peak hours, like 2 a.m., human trading volume completely evaporates, creating dangerously thin liquidity pools. When liquidity dries up, bid-ask spreads widen dramatically, meaning buying or selling a tokenized stock becomes significantly more expensive. Institutional trading algorithms, automated high-frequency bots, and market makers thrive in this low-volume, dark environment. Jordan attempts a modest trade during midnight hours and gets crushed by massive slippage, while high-tech algorithms execute front-running trades in milliseconds. Maya notes that while institutional funds run automated risk management software around the clock, everyday humans can't monitor financial prices 24 hours a day. A 24/7 market effectively transforms stock trading from a fair daylight arena into an automated nocturnal battleground where unsophisticated retail traders are systematically outmatched. So, how do you protect your hard-earned portfolio when the closing bell stops ringing for good? First, abandon the comforting illusion that stock markets sleep when you do. If tokenized equities become the new norm, overnight gap protection is history. Second, review your position sizing and eliminate excessive leverage. In a nonstop trading environment, high leverage combined with midnight volatility spikes is a fast track to automated liquidation. Third, adopt Maya's discipline strategy by setting automated stop-loss orders on resilient decentralized platforms, or hold core assets long-term without constantly checking midnight price charts. Jordan and Maya stand side by side, looking at a modernized financial horizon where traditional stock exchanges and digital blockchains merge completely. The 9:30 to 4 market was an artifact of the paper era. The always-on market is arriving fast, and adjusting your risk strategy today is the only way to ensure you stay ahead tomorrow. As always, appreciate you hanging out today. See you in the next one.